KKHT wants you to meet three of the classiest guys in real estate.
I am Chris Kelso, the maestro of mortgage.
I am Rob Cook, the godfather of real estate.
And I'm Joe Orsack, the king of credit swing. And together, we're
the Real Estate Rat Pack.
Much like us, real estate right now is smoking hot. So whether it's buying, selling, or owning, you need to check out the Real Estate Rat Pack.
They're here to take your calls and answer your questions live. Call now, 1-800-808-5548. And now, the Real Estate Rat Pack.
Same stick.
Every morning. Same stick, different week. That is correct.
For about 2 years now.
But you know what? It's a calling card.
It is a calling card.
That's right.
Well, we have
Which
kind
is
of a
kinda
different
sad.
show today.
We definitely-
If we keep Joe's Corner from popping off over
That
here.
is correct. We have a great show today. You know, one of the things we've talked about for a couple of years is that we need to diversify. And I actually got a call from Brian DeArmas about a month ago, and Brian's like, you know, Chris, we need to get together and really have a mortgage show. We really need to get together and talk, bring in some additional information in here, and really get the word out about what's going on in our industry. We're going to get the word out about what's going on with mortgages and the change with CFPB and the changes with TRID, and just talk about all the good stuff that goes in our industry, not necessarily all the bad stuff that everyone hears about all the time. Even those things modified and rates move up and down, there's a lot of good stuff going on with the changes that are going on. So Brian, I appreciate you bringing that up, and we're going to bring Brian up in a minute. But first, we're going to start off with the beautiful Renee Morton. How you doing, Renee?
I'm good, thank you. Thanks for having me.
Oh, it's a pleasure. So you are with
Renee Morton, Home Loans.
Home Loans, that is correct. You know, so a lot of stuff's going on out there. What do you think about the market right now? What are sort of your thoughts on where we stand today?
Well, I think that change is good, and I think that some of the changes that are coming down are going to help our industry, actually. One of the things with the CFPB, allowing people to be able to shop with different lenders and not have to give all their information up front, I think that's actually a good thing. So I'm excited about some of the changes, not too excited about some of the others.
You know, one of the things I tell everybody is for those who don't know, those first-time listeners out there, is CFPB is the Consumer Finance Protection Bureau. And one of the things that they are doing, they're implementing some new changes in regards to disclosures, in regards to how we disclose, in regards to the amount of days that we have to disclose in advance. They're changing a lot of things, actually. In fact, one of my favorite words they can actually come out with, instead of closing your loan, you're going to be consummating your loan, which I thought is absolutely hilarious. Ed, I know you should be laughing on that one.
Perfect.
A better term on that one, right? So, you know, you're going to be consummating your loan. So there are going to be some changes happening in regards to the way we look at mortgages. But one of the things I also believe is that the paperwork we're actually seeing, the changes in those TRID documents are actually better. The actual documentation from the good faith estimate, the closing disclosures, they actually read a lot better nowadays than what they were before.
I agree. I think that it's easier for the consumer to understand. I think it's so much better.
And what are you seeing? I mean, what are some of the things that individuals are telling you out there? I mean, are you seeing enough education being put out there? You still seeing agents who are lacking in that knowledge? I mean,
I think there's a lot of fear. I think a lot of the classes are really bringing fear to agents and to the consumers that are hearing about it. I don't think it's going to be as bad as everyone thinks. Just like all the changes that we had in 2008, they actually bettered our industry.
I would agree. I think that fear is absolutely a great way to put it out there. You know, there's a lot of individuals, a lot of misinformation going on about what's going on, about who all's out there, about what the industry is actually going to be going through. About, in fact, I see a lot of information being set out there that closings are now going to be 60-day closings versus 30-day closings or less. I see a lot of information going out there that title companies are not going to be utilized in the process. There's a lot of misinformation, and I think that's one of the things we all want to get across in today's show, is that information, a lot of it's incorrect. Are there going to be some changes? There are going to be some changes. But the misinformation is what really concerns me. And I think we have to continue to educate other individuals as to what's right and what's wrong. And there's a lot of resources out there to go to. I mean, you know, you can talk to anyone in this room right here, from you to me to Ed to Brian. A lot of good information still out there, and a lot of individuals who know what they're talking about. You know, the other thing that's going on is obviously rates are changing. How do you see rates going around right now?
They are going up, and it scares people, but they're still low. They're still even in the low fours. That's not a scary
You mean 4.5 is low?
Actually, it is. I think anything under 7 is low.
I would absolutely agree. That's one of the things that people talk about all the time is rates are moving, and rates are going to continue to move up. But how do you explain to a client who now is on the fence and saying, well, I still want to wait till it gets back down to that 3.75?
That's not going to happen. I don't think it's going to happen. The market's too volatile.
I would absolutely agree right there. everything that's going on. I tell everybody is whenever you have a good opportunity to lock in today's market,
lock
now.
Just so people can understand it, kind of say what is the attributing factor to rates moving up?
Well, the attributing factor at the end of the day, it used to be a very clear and concise way of looking at it. The bond market is what defines where interest rates go. Now, for all those who don't really understand the bond market and the yield, what ends up happening is the yield on the bond is actually set based upon how much investment they want to be brought into it. So when the yield is actually going up, that means the interest rates are moving up because they're offering a better incentive for individuals to buy more bonds. So that's a direct relationship as to what's going on in the stock market whenever the stock market ends up moving up as well.
My favorite.
The Goldfinger, right?
Yes.
So, the bond market's one of them. But it used to be it was very clear and concise as to where the market was going and to how it was moving. Unfortunately, and everyone in this room could probably talk about this, the traders have really changed the way we look at rates nowadays. You can't really look at things as you could before and say there's going to be a clear down path right here or a clear up path. It doesn't happen anymore because a lot of what's ends up happening is that the traders are really taking things in different directions. It's the same thing with oil and gas. It's the same thing with a lot of your traded commodities nowadays. It's not really done on the normal wavelengths that we used to see in the past. So it's sort of a trick question, Rob.
I just had like a 3-word question.
That's all you did, right? Yeah.
If I come up at you for the time, don't tell me how to build a watch, okay?
Well, how do you build a watch, Rob?
Well, first you just never mind. You're talking about rates going up. There was a time, and since I'm seasoned, 18%. And we had to use negative AM loans to get people into houses and things like that. So even if it goes to 4.5%, 5%, we're still going to sell houses. We thought we had died and gone to heaven in 1990. It got to 10%.
Right.
It was like, wow, we hit the mother lode.
Well, let's not look too far ago. I mean, if you look at where rates were 10 years ago, I'm just going back, to a relatively normal time frame right there. 10 years ago, the average interest rate was probably in the 8s, 8 to 9%. And individuals were still buying a lot of loan. It was still a lot of homes. It was still a very hot market that we were dealing in.
We have a whole.
I bought my house at 8 1/4.
Yeah, we have a whole bunch
of
professionals out there who've never been in that market. That's why they're panicking.
Right.
Because we've been in this low market for how many years now?
I want to venture to say we've been at least 5 years right at this point right here, 4 to 5 years.
I would say that.
And the one thing individuals have to understand is really, and I explain this all the time, the difference on an average $250,000 loan, and Renee, you can talk about this, on a 3.875 versus a 4.375. Let's just look at a half-point difference right there. You're talking about thousands of dollars over the life of the loan, but on a monthly basis, you're really not talking about a big difference right there.
No, you're not. And most people don't stay in their homes over 5 years anyway.
Very good point.
If you're looking at it like that, if you're going to move in 5 years, it doesn't really matter. It's not that big of a deal.
Right. Now, what do you say to individuals who are now really concerned about FHA adding on the permanent MI? That was a change, obviously, took place a couple of years ago, that now if you're on a normal FHA loan and you're putting 3.5% down, up to 10% down, MI stays on for the life of the loan. Right. How's that impacted your business?
Well, I try to give people two different options. I show them the comparison between straight 97% loan to value, which is 3% down, and show them the difference of the PMI, because on conventional, there is no upfront PMI. There's only monthly, and it'll cancel after you have it for 2 years if you have 20% equity in. Sometimes you have to have an appraisal, sometimes you don't.
Yep.
FHA is for the life of the loan, but if that's the only way that someone can qualify, then I encourage them to go that route, and then they can refinance in a few years once they have that equity built into, and possibly not even have any MI.
Right.
And let's assume people out there don't know all the acronyms in the real estate industry, and MI, of course, is mortgage insurance.
I love acronyms.
Yes. Unfortunately, the public does not necessarily know them or like them. And tell people what that MI does for them, because it's not insuring them from defaulting on their loan.
So PMI is for conventional loans.
Right.
MIP is for government insured loans. And
MIB is a movie.
Random Thoughts by Joe Orsak.
Squirrel.
MI is mortgage insurance, and TMI is
too much
information.
TMMI.
So on an FHA loan, you're going to have the upfront MIP, which is
the mortgage
insurance protection.
Yep.
And then you're going to have the monthly MIP, which is for the life of the loan. And mortgage insurance is there in the event that you're foreclosed on, so the lender can recoup their loss. That is always going to be tagged on to any loan that you get if you don't put 20% down.
And the one thing that's happened, it's gone down dramatically over the past couple of years.
That was exciting when FHA actually lowered the PMI. It helped a lot of people, and I think that's why we see a lot of new people trying to buy homes, a lot of first-time home buyers coming in.
And on the conventional market, it's gone down substantially as well.
It has, and the higher your credit score, the lower your PMI is going to be.
Right. We talk about credit also. Credit's a big influencing factor in buying a home nowadays. Most people, I tell everybody, the top factors associated with it, number one is where your credit stands. Number two is what type of loan you're doing, depending upon, obviously, your down payment that you've got right there. Number three is the type of loan in regards to if you're self-employed, W-2'd, et cetera. Any changes coming up that you see are going to impact anything right there in regards to new products that might be coming out for anything? Nothing. Yep.
She's like,
no, there's nothing. We got right now.
When you're dealing with the person who's looking to purchase for the first time, the market's hot. People are really going now, hey, maybe it's time for us to get into a house. I talk to folks all the time on the credit side, and very recently we started something internally where we're reaching out to people who have come to us, not referred by a realtor or lender, that type of thing, people who just found us on the web. And we're opening that dialogue with them to say, is your goal to work towards a house? And when they respond yes, then our response to them is, look, we're credit experts. That's why you hired us. But you really need to be having a conversation with a real estate expert and a lending expert, because they're going to bring up things that we don't, because credit isn't the only component in the process. For the new buyer, for the first-time person that's getting out there, that maybe be aware that, hey, I've got to have good credit. What else, the issues that they need to be aware of and working towards, that they've got their ducks in a row, so to speak, to make the loan process smooth if it's their first time that they're looking to purchase?
Well, obviously, they have to have their down payment. A lot of people think that they can buy 100%.
Yeah, I was going to say, there's the 0% thing is kind of a thing of the past, right?
If you're a veteran, of course, you can get 100% financing, and there are homes that qualify for USDA, which is 100% financing, but your income is limited.
What's the typical range for down payment stuff?
Well, FHA is always 3.5% down. And conventional, the lowest you can get it is 3%, but your private mortgage insurance is going to be higher. So the more you can put down, the lower your PMI is going to be, which will help you in the long run.
We had an individual that we had talked to that their credit had improved enough to where they could begin that process, and they decided they didn't want to buy because they had to put so much money down. They were wanting to know if we could introduce them to somebody who could get them a better down payment amount. And we're like, that's not really going to change a whole lot from person to person. It's not like this guy said, I can only get you this much down.
You should be able to save 3 to 5% to put down, and if you can't do that, you really need to wait to buy a house.
And that's a good point. Yeah, that's a good point. One of the things that took place is, skin in the game. While you can borrow some money associated with down payment on some of the type of loans that they do out there, it's still important. One of the things the government wanted to do is say it's now important for individuals to have equity into the transaction. And the days of the, Ameridreams and the down payment assistance, as far as those go, which is more of a play on the way they actually manage those monies, those are all gone. And so you have to understand you have to have money, you have to verify funds, that cash is not an acceptable form of down payment, as we always tell everybody. And you have to understand it's sometimes the right time to buy a home might not be now if you can't do that. It's all right to say, I need to wait. I need to wait another year or 6 months or 3 months. A lot of times we don't want to hear those words, but it's the truth.
And a lender's going to look at that, and you're more of a risk. If you haven't saved your own money, you're more of a risk because you're more likely to walk away if you don't have any money in it.
Oh, yeah, absolutely.
You didn't save your money and, your hard-earned money. You're going to walk away if you lose your job tomorrow. If you put 20% down into the property in your down payment, you're not going to walk away as quickly.
I would absolutely agree with that. Is Renee Morton with Renee Morton Home Loans. What's your number to reach you, by the way?
832-797-7501.
We have plenty more to come. We're going to be talking with other individuals. It's a mortgage show today, one of my favorites. Stay tuned. We'll be right back.
Are you looking to finance a new home or refinance your existing home? Look no further. Call Chris Kelso at Willow Bend Mortgage. Willow Bend Mortgage is a mortgage banker in the greater Houston area. In business since 1993, Willow Bend Mortgage offers a great array of products from FHA, VA, and USDA loans to conventional and jumbo loans, all with great rates and incredible service from Chris and his staff. Call Chris Kelso at Willow Bend Mortgage today, 713-256-9138, or online at chriskelso.com. Again, that's 713-256-9138 or online at chriskelso.com. Available 24 hours a day. Great rates, exceptional service. That's Willow Bend Mortgage.